Hello and welcome to our real estate investor workshop. Today we'll be discussing the infinite banking concept. My name is Michael Matthew. I've been a professional accountant for more than 30 years. My international practice is increasingly focused on real estate and real estate investors. I'm also the CFO for a local home builder. I currently own a condo in the Toronto area, and I'm looking for small apartments in the US, initially in Texas. The services I offer include entity structuring or setting up corporations in Canada and the US, operational and tax consulting and planning, and tax return preparation for both Canadian and US returns. Plans for the group is to meet once a month at 7 p.m. on the last Thursday of the month, subject to change around holidays, etc. The content will be delivered by me and various guest speakers. Happy to take suggestions for future sessions from the group. Now, to keep my lawyer happy, I have a brief disclaimer to read. None of the information provided in this presentation or through this presentation is given as tax, accounting, or legal advice, and it shall not be relied upon as such. None of the materials are to be construed as a solicitation, recommendation, or offer to buy or sell any security, product, property, or instrument. And while I do my best to keep the information as up to date as possible, a new law could be passed tomorrow, a new court case decision could be reached tomorrow, and that may very well change what I would have advised you in this presentation. So please, before undertaking any significant transaction, consult with your advisor. And if you would like to have an in-depth consultation, I offer a free 30-minute consultation with me. My email address is on the screen. So there'll be time for questions at the end of the presentation. For now, please just put them in the chat. Our next event will be on December 29th at 7 p.m. And the topic will be using Excel to evaluate a property. So please grab a pen and some paper or open a computer document and be ready to take some notes. Tonight, we have a guest speaker, Scott Cordier, to discuss the infinite banking concept. He's one of only 44 advisors in the country that actually understands what is wrong with our financial planning system and how to fix it. So, Scott, I will turn it over to you if you'd start sharing your screen and start your presentation, please.
Perfect. Thank you, Michael. I appreciate that. It's kind of unfortunate when things can change so quickly that the disclaimer has to be as long as you had to make it, isn't it?
Yeah, well.
What I wanted to do tonight was just have this more like a town hall meeting. I don't know about you and most of the viewers are going to have, but I'm kind of sick of watching PowerPoint presentations. So I really just wanted to have an open forum where everybody asked me questions regarding infinite banking, and then I could start digging deeper into the weeds as to how to implement it, not just for real estate, which is a perfect marriage, but how infinite banking is truly supposed to be used for every aspect of your financial life. So I'm just going to take a step back for a second and field a couple of questions that might pop up. George, I know you had one that you wanted to ask me right off the bat.
Yeah, I think with regards to infinite banking, I just want to use the example of, I'm involved in several transactions where I get access to these big lump sums, let's just say 6 figures, and ideally I'd like to put that directly into an IUL, and just wanted to know if that was something that was available in the Canadian market and how one would go about moving something like that.
Yeah, so let's strip it right down to the ground level and we'll build up the concept from there. So in Canada, in the US, there's two types of life insurance. There's term life insurance. So think of this as renting, right? So you own a you own a rental property. These are the tenants who are paying for you. They have no equity in the property whatsoever. It's all yours. So the insurance company owns the term insurance and you are specifically just renting from them. You have no cash value, nothing whatsoever. When you go up to the next level, which is permanent life insurance, now this is life insurance that you own and you have it for life. With term insurance, all the risk is on you passing away while the insurance is in place. With permanent life insurance, all the risk is on the insurance company because you're going to die while you're paying the premium, so they have to pay out the death benefit. Inside of permanent life insurance, you have, as you suggested, IUL, which stands for Indexed Universal Life. And that is essentially a term to 100 policy, plus the opportunity to add money to the policy in the form of investing. And that money inside the policy that you're putting into an investment grows tax-free and is added to the death benefit. But like every investment, it has a degree of volatility. It's market-related index, like index S&P, TSX, NASDAQ, whatever. It is reliant on how well the market does, minus whatever the fees are going to be involved in the management of that type of asset. The next type of permanent coverage is called whole life. And whole life is where we implement infinite banking. Whole life has no risk attached to the portfolio whatsoever. It can never lose money. By the time this presentation started to the time this presentation stops, my cash value in my policy has already gone up. It goes up every second of every minute of every hour of every day. So there's a big difference between whole life and universal life in the fact that there is a higher degree of volatility with a universal life policy. On the flip side, though, George, because it is related to an index, the opportunity for a higher rate of return certainly does exist. But with that higher rate of return also comes the higher probability and possibility of a financial loss. So what we like about permanent whole life insurance is that since it can never go down, it's really easy for us to be able to look into the future and make calculations. Secondly, if you wanted to borrow money against your indexed universal life policy, because of the volatility, you're going to be allowed to do no more than 50% loan to value. With whole life, you're able to do 90%. So that's 90 versus 50. Right off the bat, which would you rather choose? And almost everybody's going to go with, I want the 90% because I want to have the highest access to my liquidity as possible. Anything you wanted to add on to that since that explanation?
Yeah, I think for me, having access to that 90% makes sense, and I think I'd love to get your takeaways as someone who's thinking about investing or getting into real estate. Again, using that example, I have 100,000 or 200,000, as opposed to putting it directly into real estate. That there's one additional point where I could secure that capital in a meaningful way long term while getting access to it to deploy. I'd love to get maybe some more perspective on that for myself and all the people listening.
Perfect. A lot of the times when I get that question where I've got this large lump sum and I want to put it inside the policy, it's normally derived from viewing information regarding infinite banking from south of the border. The whole insurance industry and the whole tax industry, as Michael can attest to, is completely different once you cross that invisible border from Canada to the US. The big difference in the US, life expectancy for policies go to 121 years of age. So think of that like an amortization schedule. If you're 50 the insurance industry has an amortization schedule on you of 71 years. Because there's an extra time frame, in Canada, we only go up to age 100. Those extra 21 years goes a long way to being able to create a policy where you can dump in those larger dollar amounts, because it's going to have less of an effect on the death benefit, because they're not planning on for you passing on 21 years later, past age 100. In Canada, we're not, unless you're making a very high 6-figure to a 7-figure income, you're not likely going to be able to dump in that large dollar amount at one time. It's going to have to be like the saying, what's the best way to eat an elephant? One bite at a time. So that $100,000, we might be able to get into a policy over a 2 to 3 year period. Unfortunately, just not all at once. Because in Canada, unlike the US, I look at infinite banking in the US as concept first, insurance second. Have you ever heard of the phrase, don't let the tail wag the dog?
Absolutely, yes.
Yes. So down there, you can have the tail wag the dog. Up here in Canada, it is insurance need first. Once we figure that out, now we can figure out how much money we're able to deposit into the policy. It's not quite the same as it is in the US.
Got it.
So when we're going to look at real estate, understand that in real estate, it's going to take you a period of time to capitalize the system for you to be able to have a down payment, to capitalize the system to be able to fund a flip, capitalize the system to be able to lend money out on second mortgages. It's going to take some time. But once that capital starts to roll in, where we have always found the issue in comparing infinite banking to real estate is, why wouldn't I just put my profit down into my existing house or down into my next house so I can pay down that mortgage and refi that money back out again like a burr? And that strategy makes all the sense in the world when house prices are going up. But as soon as house prices start to come down, where's your access to liquidity? You're not refining a house that's gone up in value. The house has gone down in value. So one of the biggest issues we try to get real estate investors to understand is, we love real estate. Personally, I hate RSPs. I hate the stock market. I have no money in those two vehicles whatsoever. In the real estate side, if you focus in just one column, one asset class, it's going to be great while that asset's going up. But when the asset's going down, that's when the opportunities present themselves. And if you don't have access to capital that is completely non-correlated, that can never go down, do you have an opportunity or do you have a problem? What's the answer?
That would be a problem.
Exactly. So now think about this for a second. And this is a really important aha moment. So everybody watching this on the recording, come in close so you can hear this properly. George, you're the bank. You know what? I'm the bank. George, you bring me two assets. One asset is the title to your house that's worth $1 million and is completely mortgage free. So there's $1 million worth of equity in that house. And you bring me a life insurance policy that has $1 million of cash value. Both are identical assets, correct?
Well, probably not, but yes, they're collateral, they're equivalent collateral.
Exactly. Now, how much will the bank give you access to that $1 million on your house?
Oh, probably a loan to value 70-80%.
Right. And will that 70 or 80% be all a line of credit, or will it be a line of credit mortgage combo?
Probably a combo, depending on
Right.
your situation. Yeah.
So it's currently at 65-15.
Yeah.
Now, the line of credit is readvanceable, it's liquid, the mortgage is not. Now,
I see.
why does the bank not give you 100% on that house? It's a house, it's paid off. Why is it 20% left off the table?
Oh, well, I think they need to be able to recoup their capital quickly, and they need that buffer to move the asset at a discount and exit should the need arise for them to foreclose.
Right, because the house can go down in value.
Yeah.
That 20% is the historical rate of return or decline in houses going back to the early 1900s. So they leave that meat on the bone because of that volatility, that potential for drop. But that insurance policy, the bank is going to give you 100% loan to value. 100% because it can never go down in value versus 80%. Where do you want to start storing your wealth?
Yeah, it's huge.
Exactly. And the life insurance policy is going to go up every single day, which is why the bank will give you 100% loan to value. The house can go down. So if we get real estate investors to start to understand that a more liquid and lucrative place to store your capital that is not exposed to a market, a housing market that could decline in value, now allows those people the liquidity to go in and take advantage of the opportunities, where if all of your liquidity is inside of the house, the mortgage, the real estate, you're not going to be able to get access to that financing. The second part of that, has anybody ever gone into a real estate deal with the bank and had it not screw up at some point down the line, where suddenly they go, oof, we don't like the loan to value anymore, or we need these extra documentations, or you need to sweeten the pot? They always come up with something. And eventually you're going to get your debt servicing ratio to such a point where they're not going to give you a loan anymore. And when they do give you a loan regardless, who has all the control as to how that loan is structured? You or the bank?
The bank usually.
Right. And I'm sure everybody is aware. If not, then please search this online. But the government is changing the rules next year. And they're looking at changing the home equity line of credit combo to a maximum 65%, not the 80 anymore. They're looking at restricting the use of home equity lines of credits for real estate investing. And the bank controls the whole process. And you are required to make monthly payments back to the bank. So I'm going to ask you a question. If you could put your money into a vehicle that was a completely safe warehouse of wealth where you could not lose money, it was guaranteed to grow day after day after day, you controlled the banking function where you made the rules as to how much to borrow from what you've capitalized, when to pay it back. If you want to pay it back, you're under no obligation to pay back the loan. There's no credit check, there's no credit application, there's no credit score. It does not show up on the credit bureau. It is a completely private loan between yourself and the bank. And you control the payments. And you get 90% loan to value. Would you want to put your money there?
Absolutely.
Exactly.
Absolutely.
Imagine having a deal where you are not required to make any payments back until you want to. Something happens and your tenants stop paying rent. The bank doesn't care. You got to keep making your payments. If you had financed that through your own banking system that you created, they don't pay the rent. Nobody's knocking on your door because you're the bank. You use this for hard money lending. You use this to fund flips. You use this as down payments. You control the whole banking system. And not having to jump through the hoops of the bank gives you complete control over the deals you choose and how you choose to finance them. So when the housing market declines in value, I'm going to have complete access to capital, and I'm going to be able to get that access to capital within a couple of days with just a phone call. Whereas how long is it going to take to go and get that money from a bank? Weeks. And the worse the environment is, the more risk they think they're going to take, the more you're going to have to jump through fiery hoops to get the deal done. So that's a really important aspect that we have to understand, that we need to keep our money in a completely safe warehouse of wealth that is not directly exposed to the stock market or real estate. I want to continue on with a couple of other ideas, but I want to open the floor for any other questions before I start going down a deeper rant.
So how does one get started? Like, what's the process? Obviously, reaching out to someone like yourself, but I guess one of the things that I'm aware of is people tend to disqualify themselves from an investment or a strategy, and that's always a dangerous approach to life. So, uh, who's the ideal target? Who could get started, and what should people be mindful of to take the steps to inquire and pursue a strategy for themselves and their family?
So let me start off with one really key point. Infinite banking is not an investment. It is the exact opposite of an investment. By definition, investment has an element of risk, the possibility for loss of not just some, but all of your money. This is nothing more than a safe warehouse of wealth where the ultra wealthy have stored their money for hundreds of years. In the US, you can go to Google right now and type in BOLI, bank-owned life insurance. After the 2008 financial crisis, the banks have had to go under a stress test, and tier one asset has been required that the banks have to have as much money as possible in a tier one asset to essentially bail themselves out if there is another financial crisis. So this tier one asset has to be the safest, most liquid asset class. The banks in the US have more money in cash value life insurance, and I hope you're sitting down for this next part. They have more money in cash value life insurance than the value of the real estate they own that their banks sit on. Think about that. 50 states, hundreds and thousands of cities, and like McDonald's, they all own the real estate that their banks are on. And the cash value policy is worth more than that real estate. So who is this for? It's for every single person. The only problem with infinite banking, it's the only asset that you're going to have access to that has a health qualification. If you're not healthy, if you've got cancer, you've had 3 heart attacks, a stroke, right? You're not going to be able to get insurance, which is unfortunate because that's the vehicle that we use to duplicate the process we need for infinite banking. But that doesn't mean that you can't get insurance on somebody else. If you're doing joint ventures, you can have insurance on that other person and have an infinite banking policy because you own it, you're the payer, and you're the beneficiary of it. So anybody out there doing joint ventures, anybody out there who has a spouse, right? One's not healthy, the other one is, can do infinite banking through that spouse. Do it through your children. Do it through nieces, nephews, brothers, sisters. The opportunity to have insurance on other people is going to allow you to still implement this policy. Sorry, George, what was the other question about who is this for and how do you get started? think that was it.
Yeah, just what's the path for someone to pursue, getting into this asset class, as you mentioned?
So that's a two-part question. One is the simple one. You get a hold of an authorized practitioner. So you can go to infinitebanking.org and you can search for a practitioner in the US and Canada. And you can search by state or province. Our website is ibcanadagroup.com. So I for infinite, B for banking, Canada group.com. And out of the 44 authorized practitioners in the whole country, our group has 21 of them. So we have a wealth of knowledge and we cover Canada from coast to coast, including the territories. You want to become educated regarding the problems you don't even know you have. And this is a big part of infinite banking. When I go through the education process, I'm educating people regarding the problems with RSPs and why they are not a very good retirement planning vehicle. I educate them regarding interrupting compounding interest by paying cash. I educate them regarding why allocating extra money to your home is actually going to make you poorer. All of the foundational aspects that we've been led to believe we should be doing are all going to make your financial future worse off. And I can say that because I've been in that business for 28 years. And I look at infinite banking as the red pill solution. So I would love to get into why RSPs are bad and why paying cash is bad and why paying off your mortgage is faster. But I'll open it up to you and Michael if we want to go down that path. For me, it's the foundation as to why we do infinite banking. The second part as to why we do infinite banking is, do either one of you know what fractional reserve banking is?
Yes, it's the ability for the bank to take in a dollar and somehow hypothecate a minimum 10 times more into the monetary
Exactly.
system to lend out.
So here's a real kicker. You can ask almost any politician and 99% of the people on the street what causes inflation. And they're all going to have the wrong answer because that's what we're led to believe. Inflation is just the increase in the price of a good, right?
At least that's what they tell us. Yes.
Right. Inflation is the representation in the price of a good. It's the representation of the devaluation of our dollar. So when the banks take your money on deposit, so you got 10,000 bucks, or as you said, there's $100,000 sitting there. Let's say you're really lucky and the bank is paying you 1%. 1% on $100,000 is going to be 1,000 bucks. So that's their liability to you. But the banks get to take your money and, as you said, at a minimum, leverage it 10 to 1. So then they now create $1 million worth of fake money. It never existed. It still doesn't exist. It's just X's and O's or ones and zeros in computer programming. But they create that $1 million and they lend it out. Well, let's say they just lend it out on car loans at 6%. 6% of $1 million is 60,000 bucks. They're making $60,000 on fake money while they're paying you 1,000. That's a pretty good spread and a huge amount of profit just because we leave money on deposit. So that's one problem, and that creation of $1 million extra dollars goes into the system. We borrow it and we go out and we buy goods. Economics 101, if the demand is greater than the supply, the price goes up. Inflation. When they print money or they create money that doesn't exist and it's not backed by anything that's, of any factual, tangible value, they dilute the value of the money. You flip over to the Federal Reserve in the US, the Bank of Canada here, or the Bank of England across the pond, When the government wants more money, the only way they can do it is by going to the Federal Reserve or the Bank of Canada and ask them to print it. The Federal Reserve prints it, sells it to the government, and the government then puts it into the system. But the money never existed. It's just a piece of paper. And if you create more pieces of paper without any tangible asset backing it, it devalues the currency, which inevitably ends up as inflation. So it's not that the price of an apple went from 69 to 89 cents. The apple's still 69. It's the value of our dollar is worth less now and has to be represented in the price of something we pay. So both quantitative easing, which is the printing of money post 2008, and fractional reserve banking that happens all the time, you add those two together and you're going to have inflation. To combat inflation, you do quantitative tightening, which is pulling money out of the system, and that now pushes interest rates up, and they use the interest rate increase as a ploy to get us to believe that they're doing that to fight inflation. So what they're doing is that they're creating the problem in the first place and then trying to solve the problem that they created, knowing that they're just going to continue the cycle, and they've done this since the Federal Reserve came into play back in 1913. That at the outset is why we do infinite banking. Once your money is inside of the insurance, there is no fractional reserve banking. There is no voodoo math. There's no weird economics. Your money inside of the insurance policy is 100% safe, and in fact was the only asset during the Great Depression that didn't go down. So imagine having your warehouse, your wealth stored in that type of warehouse. When every asset goes on sale, you had the opportunity to cherry pick the best deals. So that's one of the main problems that people aren't even aware that exists out there. Fractional reserve banking has just been lost to time. The truth is gone. And for people to leave money on deposit at the bank, you are just adding to the problem. The other part is, if anybody wants to double check this, as Michael's disclaimer, go take a look at the Canadian Bank Act or the US Bank Act. What people do not understand that when you put your money on deposit, your bank account, the savings account, it's no longer your money. You've given up all rights and control to that money in lieu of interest payment that the bank's going to make. You've now lent it to the bank, and you're a junior creditor. Now, sure, that money is a demand loan. You can demand it at any point as long as the bank has it. But if the whole economy starts to fall apart like it did in 2008, it's going to be the same as it was during the Great Depression. And because of fractional reserve banking, you might find you have $10,000 instead of $100,000. And I know people are going to say, yes, there's CDIC insurance to protect us. My question is, why does the government need to protect us if our banking system is safe and the money in our accounts is safe? Just ponder that question for a second. Why is there CDIC insurance to protect our money if our bank account, as we've been led to believe, is an incredibly safe place to keep money? And that's because the government allows for fractional reserve banking to occur, and they know the risk. The problem is there's no money in CDIC insurance to back up the $856 billion that it protects. So between you and me and everybody else, CDIC is a sham. It does not exist. It is purely there as a decoy to make us feel comfortable about having our money in a system that it's no longer our money. So that's first and foremost the biggest reason why we do infinite banking. Anything else?
Nothing specifically right now. I'm not sure if Michael has any specific questions, but feel free to point out anything that you think is important for someone to
Sure.
really grasp with regards to this.
You have anything, Michael?
Yeah, just on the CDIC, I can't quickly find the exact figure.
So you
But,
go to the CIC website, you look at their audited financial statements, and you can scroll down and take a look at their outstanding liabilities.
okay,
The
well,
last time I did this was March 2020, and it was $856 billion on that they were insuring on deposit.
I,
Now, understand that 856 at a 10-to-1 ratio through fractional reserve banking becomes $8.6 trillion. That is out in the system, backed by 856 billion.
yeah,
The federal, yeah.
I think the figure that I heard, and I'll have to look it up later, but if all the banks failed, the projected payout by the CDIC was less than 3% of your money.
Yes.
So 97% is gone.
And that's an over exaggeration, because when I looked at the audited financial statements, CDIC insurance was 99.4% unfunded. 0.6% of the money is actually sitting there. So ask the question, where's the money going to come from if crap hits the fan? Are they going to pay us back, or are they going to keep the lights on to the country? The money we have in our bank account, we are led to believe is one of the safest assets we're ever going to own, when in reality is the riskiest one you're ever going to have. And people need to understand that you have no ownership of that money once it gets deposited into your account. So that's an important one. The biggest benefit for me is recapturing lost opportunity costs. How do you turn an expense into an asset? Anybody have an idea other than just ask Scott? Because this will be a good one for you, Michael.
Whole life insurance.
Oh my God, good one, George. So let's pick an expense that everybody has. Who goes on vacation, and how much money do you spend on a vacation?
Well, Michael, you can
Bro?
speak to that. You did that recently.
Yeah, well, the problem is because of the pandemic, we started paying for part of it in January of 2020, and we actually went on vacation
Yeah.
in September of 2022, and costs were at that point. But I'd say ballpark 5,000 a person.
And so how much would that be in total?
For our family, it's $10,000.
Okay. So there's only two ways to finance that expense, or essentially any expense. They both start with you working and exchanging time for dollars. Those dollars then get deposited into a bank account, which you're either one, a saver, or two, a spender. If you're a spender, you're going to borrow somebody else's $10,000, go on vacation, and then when you come back from vacation over the course of the year, you're going to work to earn money to pay back that $10,000. Or you're a saver and you allocate, let's say, $833 a month to a segregated account that's called vacation fund, and you save up that money over time. You get your $10,000, and then you exchange the $10,000 for the vacation. So either one, you still have the $10,000. One person's going to pay $833 back to pay back the loan, or one person's going to save $833 to save it up. Now, if I was a spender and I used somebody else's money, I borrowed somebody else's money to go on vacation, did I finance that vacation? Yes or no?
Yes.
Yes.
Now, if I saved up the money and I paid cash for it, did I finance that vacation?
Yes.
Why? Oh, we're split here. Arm wrestle time. Let's go. Or is it a Jello fight?
No, we prefer thumb wrestling.
Okay.
It's the more gentlemanly sport.
Is that with the screen off, so nobody can really tell who won?
Yeah. Yeah. Well,
So,
if
Michael, you said
I'm
yes,
saving up the money, then I'm financing it through my own efforts.
right? But you paid cash, so there was no interest cost, right? If you're a spender, you're paying somebody's interest, but you pay cash so you can avoid interest.
Well, there's opportunity cost because I didn't spend that money in another area.
There you
It was
go.
kept for something.
So what everybody has to understand is we finance everything we buy. We either pay interest to somebody, or if we choose to pay cash, we choose to give up the interest that that money could have earned. So that vacation didn't cost $10,000. That's its present value. Its future value is if you had been able to keep that $10,000 and had it grow for you for the rest of your life. So as you said, there's a lost opportunity cost there. And I know people are going to go, yeah, but hang on a second, how do I pay for the vacation? Like, I'm not going to not go on vacation. And I'm going, if there was a way to still pay for your vacation, but have the money never leave your system, so it continues to grow while you're on vacation and every day after that for the rest of your life, wouldn't you want to put your money there? Of course. So if we can understand that process every month, like a set of stairs, we put $833 on each step. At the end of 12 months, there's our $10,000. We grab that money and jump off, land back at ground zero, hand over the money, and then start the process all over again. That's the definition of insanity, repeating the same thing over and over again and expecting a different outcome. So if we understand the saver or the spender, it's the same dollar amount. One's just paying interest, the other one's giving up the ability to earn interest. How do we recapture it? So I like to use the example of an apple tree. On day one, when you started putting this money away for vacation, let's just exchange it with the concept or the analogy of an apple tree. You planted an apple tree. 12 months later, it's now time to harvest the apples. I'm going to give you two choices. The first option, I'm going to give you a ladder and a basket, and you can pick the apples. Option two, I'm going to give you a chainsaw, and you can cut down the tree. What are you going to choose?
The ladder and basket.
Good answer, but why?
Because then I could continue to pick apples in the future.
Right. So when you come back a year from now, will that apple tree likely be larger and have more apples?
Sure.
And 5 years from now, 10, 20, 40? It'll be larger. There'll be more apples. So if we wouldn't, if we're going to pick the apples, we're allowing that tree to continue compounding its growth. We're not interrupting its growth at all. So if we understand that simple process, why do we cut down the tree when it comes to our money? I love the silence, the pondering, why do we do that? Because when we pay cash, we cut down that tree. And we got to start all over again building up that asset. We got to start all over again planting the tree. Inside of infinite banking, because you have created that warehouse, you have already, like in the saver, capitalized your system with $10,000. You get to borrow against that money. Pay cash to go on vacation. And when you come back, the 833 is now going to pay back the loan. But the cool thing is the $10,000 never left your system. So by the time it's time for your next vacation, that $10,000 has grown. And you repeat the process. And when you come back, it has grown. It's the apple tree. It continues to grow. So now I've just turned an expense into an asset that's going to continue to grow and make money for you for the rest of your life. And if I can do that with something as simple as a vacation, can't I do that for, I don't know, a car loan, income tax? Michael, your expense, like your charge to any of your clients, that's a repeatable expense.
Yeah, let me just interrupt you there. I'm not an expense, I'm an investment.
Exactly. But now we turn that investment into an asset. That is still money that they're paying that they're not going to be able to recapture 100%. Thank you for allowing that to be caught and to impress upon how important your services are. But now we can make our income tax an asset. We can make our kids, post-secondary education, or our kids' private school, or our kids' hockey. We consider that to be an expense. We can recapture that and make money off of it. The stupidest thing about financial planning, and I absolutely hate this book, and most of you have probably read or at least heard of it, The Wealthy Barber, just emphasizes the problem with pay yourself first. Okay, love that. Pay yourself 10%, and then the other 90 you can flush down the toilet, because that's just lifestyle. And then use all of your energy to try to grow the 10%. When with infinite banking, we can recapture a lot of that 90%. And if we can recapture our expenses, aren't we going to have more money in the future? And we don't have to take on the risk of the stock market to try to grow the other 10. And if we have all this liquidity, are we ever going to run into trouble? Because now we're our own bank. And if we lose our job, or an opportunity presents itself, or we get sick, we have our own capital to borrow from on our terms, with no required repayments and no opportunity to have to go through a credit check. Try to get a mortgage if you're unemployed. Try to get a line of credit if you're unemployed. Bank's not going to do it.
Yeah.
If you've already created your own banking system, who cares? So the lost opportunity costs of cutting down the tree every time we pay for something is hundreds of thousands, if not millions of dollars in lost opportunity costs, because that money is no longer in our system to compound.
Right.
Any questions on that one? Because that's a big one. That is where the majority of people's wealth is lost.
No, I just think it's something that I'll have to review the recording myself, because it's, you say
you nailed it.
Most people don't know about it, or so most people don't do it. Why? Well, they simply don't know about it, right? Just
Exactly.
like when I get to some more advanced tax strategies, most of them are not new. It's just that people are not aware of it. And, why would you be if you have nothing to do with that area?
Exactly.
I know more about taxes than the average bear, because I'm in it every day. And today I just did a 3-hour professional development course, and yesterday I did a 4-hour one, earlier in the week, I should say. And I learn new things too. So, and LinkedIn, I was looking through a tax group, and they mentioned this new rules come out in 2023. I never even heard of them, but it directly affects people who own real estate through a corporation. So I'm going to have to read up on them and pass on the details.
And it's always changing.
Right.
What we're trying to do with infinite banking is to eliminate the things that you can actually control. You can't control the banking function, because the banks control that. They make the rules, they'll change them. Remember what happened back in May of 2020 as COVID was unfolding. I believe it was Scotiabank that put a complete freeze on accessing lines of credit for real estate. Now, no other bank followed suit, but that is something that is in OFC's discussion paper for implementation in 2023. So we have a whole industry that's completely required or reliant on the accessibility of capital through the banking system. And it can all come crashing down because we haven't diversified into a system where we can control and set our own policy. And that's the beautiful aspect of being able to capitalize a system with infinite banking, because you control the banking function, and the loans are 100% guaranteed. I probably didn't mention that, but contractually, you're 100% guaranteed to get the loan, regardless if it's a depression, a recession, If you're bankrupt, if you're unemployed, means no difference. That is access to your own capital. And that is very important to be able to see you through some of the darkest days. But you alluded to something very, very important there, Michael. And it's one of the things that resonates with the discussion of infinite banking. And this is a simple question to both of you. If you're not aware of a problem, tell me how many hours you're going to spend looking for the solution.
That would be 0.
Exactly. So our job is to get people educated as to the problems that are right there in front of them, but they have been essentially nose blind to them because the powers that be don't want us to know that they're there, because that's how they make money off of us.
Right.
So as soon as we can start to educate people regarding the problems in the system, we can get them to start making proper choices and getting their money out of a system that is predominantly fraudulent. That printing of money is completely illegal. It's counterfeit cash, but we're forced to treat it as legal tender because that's what it says on the dollar bill. I shouldn't say dollar bill anymore because they don't exist. On the $5 bill, legal tender.
Yeah.
So it's really important that we want to be out of that system and into a non-fractional reserve entity, which is where the life insurance allows us to store our wealth.
Okay. Now, I have some points that have come in, and also some things I've wondered about. So you mentioned you need to be healthy to get a policy because it's insurance based. But as a practical matter, there also must be an age limit. So as a practical, I mean, I'm sure you could do it, but at a certain point, there may not be enough runway to get the best of returns. So
right. So
how
let's take that for example.
Is basically what I'm saying for this to work well.
Too old is purely a lack of imagination. So I'm going to use one of the most famous families, the Rockefellers. When a child is born, a grandchild, the grandparents open up an insurance policy on that grandchild, and they start transferring that wealth to the third generation. So this is where I was talking about, you can put insurance on other people. So if you have somebody who is 70 years of age, one, it's going to be really expensive for insurance for a 70-year-old.
Right.
Two, there's likely going to be some health issues, which is going to make that even more expensive. But that 70-year-old might have a 40-year-old child. Well, that 40-year-old child, the parents can now take out insurance on that person. And because the parents own the policy on that child, they also pay the premiums and the deposits on that child, and they're the beneficiary of the insurance on that child. The child is simply nothing more than the insured entity. And the parents can now start to store their wealth in that policy and implement it like infinite banking and turn expenses into assets. Then the really cool thing is the child is now the contingent owner. When the parents pass away, that wealth has now automatically gone tax-free into that policy, and the child now takes over the policy as a brand new IBC policy. And that's what the Rockefellers do. Is essentially, for anybody who is old enough to remember the toy, the Slinky, it's a Slinky going down a set of stairs that never ends. It's generation after generation of wealth transfer. So even though you might be old, you still have a banking function. You're still going to be buying things. You're still going to have the fact that we finance everything we buy. So we can start to recapture that in your system, but that system is on somebody who's 30 years younger. Then that's what you want to implement. And then you never gave up control of the money because it's still your policy until you pass away, which at that point, you're not taking the money with you anyways. So now it automatically bypasses probate, and is now in the hands of the next generation. And there's no time to wait. There's nothing to clear, just an instantaneous conversion from that owner to that owner.
Okay. Now, I like to ask rule out questions when I'm discussing strategies with clients because I find it's a very efficient way to do it. And there's often 2 or 3 questions you can ask them. If they give a certain answer to one of those questions, is, oh, this won't work for you. So with that in mind, as you get older, as you just mentioned, your premiums would naturally go up. As you get sicker, your premiums would naturally go up. But is there any sort of guideline of what kind of premiums you need to pay to make this a worthwhile exercise for yourself?
And you just nailed the perfect question that shows how, and forgive me, I'm not pointing you out. This is a question that I get probably 4 or 5 times a week when I'm talking to people. When you put money into an RSP, do you ask how much that is?
No,
When you put money into a TFSA, do you ask how much that is?
no,
What's this going to cost? No, because we define those as assets, correct?
yes,
And if it's an asset, you want to put as much money as you can into it, up to the amount that we're allowed to.
right, up to the
But
level.
we have been conditioned to think of insurance as an expense. And therefore we ask how much. The definition of how much money is defined based upon how much money we can find that is leaking out of your system. RSP contributions, TFSA contributions, if you're paying cash for things, how you're financing them, if you're paying off your mortgage faster, all of those, that 90%, that's what we want to recapture. So the insurance is one designed around human life value, call it 20 times your income, plus whatever expenses you have. So real estate investors have a lot of expenses. I've got this mortgage and this mortgage and this mortgage, etc., plus my income. We want to make sure that if something happens, we have instant cash that's going to allow for those assets to still stay intact, carry on the mortgages, whatever we want, or to pay them out completely up to you, but that's what the insurance is for. But once we figure out that insurance amount, we want to look at how much cash do we have that we have recaptured through essentially just distributing it in the most inefficient way. That's now the premium. So when we design a policy, we push the cost of the insurance down so that we increase the amount of the deposits. I hope I answered the question, because it's really the way the question should be asked is how I answered it. But the traditional way is we've been taught to think of insurance as an expense, and therefore, what is it going to cost?
Okay.
And every policy is as unique as a thumbprint. When I did my policy, when I was 55. So it took me 25 years of searching for the solution. I did my policy at 55. Was it as cheap as it would have been at 54? No, it was more expensive. That didn't stop me from doing it. It's just designing the policy properly based upon the expense to me allowed me to have a policy where I can dump in a very large amount of money on an annual basis and start to recapture all of my expenses. So it's not to be looked at as an expense. It's purely, if there was an asset that you could never lose money and get 3, 4, 5, 6, 7 times the amount that you put in back again tax-free with no risk, how much money would you want to put into it?
Okay.
That pause must mean the big question is coming now.
No, I'm just trying to absorb it all.
Yeah.
I've heard this discussed by you, oddly enough,
Yeah.
before, but
Are you calling me odd? 'Cause I'm okay with that.
no, not to your face. And a concept like this that is not well known, I think we can agree that it's not well known.
Yep.
For me, at least, it takes a couple of times hearing it before it really starts to sink in and get solid in my mind. So I think probably we should schedule a meeting between the two of us to kind of tie a bow on it. And
Yes.
because well, we'll get into it, but next year could be a good year for me to do this. So for
It's
myself.
the great thing about infinite banking is recapturing control of the banking system and not utilizing a system that is rigged against us from the start. But we don't realize it's rigged because it's the only one we've ever had. Our very first memory of a bank is a piggy bank. And what do we do with it? We save money. And that money just sits there and doesn't do anything. And that's what the bank wants us to do with our money on deposit. It just sits there. And we're told the only way that that money is going to grow, leave it sit there and have compounding. But the bank doesn't do that with the money. The bank, as we said, leverages out 10 to 1, puts it out into car loans, collects all that premium from that $1 million, pulls that money together, lends it out for a debt consolidation loan at 9, takes all that money, pulls it together, sends it out for a construction loan at 12, pulls all that money together, then lends it out to credit cards at 28. The money's always in motion.
Yeah.
It's like stagnant water. If water doesn't flow, it becomes stagnant. It's poisonous. It's not usable. Money in motion is the same as water. It has to flow, but they tell us to just leave it there.
Yeah, well, we're the ones providing the water.
We're providing all of the water, the food, the nutrients, everything for them to be able to utilize it for their profit. And don't even get me started as to why paying off your mortgage faster is horrible. Maybe that's a whole other seminar.
It could be. George, anything else from your side or anything else in the chat that we should bring up?
No, I think it's important that people really look into this topic when it comes to their wealth planning and also legacy planning. You mentioned that this is a strategy that banks use primarily to underwrite their balance sheet, but I think as individuals, we should be mindful in using it on our own balance sheets.
Oh, completely. And can I just inject there for a second? What does Walt Disney, Ray Kroc, not the original founder of McDonald's, but the person who bought out the McDonald's brothers. So Walt Disney, Ray Kroc, Jimmy Pattison, the Canadian billionaire from BC, Doris Christopher, the owner of Pampered Chef, Joe Biden, Ronald Reagan, anybody a college football fan? No, but no, the coach Jim Harbaugh.
Yeah.
Okay, what do they all have in common?
You lost me when you expanded to athletes, politicians, business
life
people.
insurance.
Yes, Walt Disney borrowed against his insurance policy to fund Disneyland.
Okay.
Ray Kroc did exactly the same thing to buy out the McDonald's brothers and implement the mascot Ronald McDonald. I didn't even put in J.C. Penney, the department store, utilized the cash value in his life insurance, borrowed against it during the Great Depression to keep the store open and pay salaries. Jimmy Pattison, who owns Great Wolf Lodge, Guinness Book of World Records, believe Ripley's Aquarium, Sunripe Juice, started his empire buying his first car dealership by utilizing his life insurance policy, borrowing against the cash value. the Joe Biden used it to fund part of his presidential campaign. The list goes on and on. The difference between them and us is literally nothing more than they have extra zeros in their bank account.
Yeah,
And
and
as
Scott,
such, they have access. Yep.
yeah, and I think that that was my takeaway is that as someone that works with businesses and advises on management on how to leverage excess cash on their balance sheet, this is a vehicle that, as we said earlier, if these great men of the past and current are using, and also
Exactly.
corporations of the past and current have used. If you're a business that has cash flows that sometimes you're talking about 500,000 or more, this is a great way to again preserve that capital, both in your lifetime and lifetimes to come.
Yes.
Which is a strategy that most businesses don't think about. And Michael already knows this as well, that um, most businesses rarely think of the future.
Yeah.
But this is a great way to do it. And I just want to thank you for sharing this with us. I know we've been at this for almost an hour and a half, and we are
Wow.
excited to understand, at least get a preliminary understanding. And as Michael said, we may need to invite you back to deep dive, do a further deep dive. But thank you
That'd
for
be
this.
great.
Great.
Thank you. I hope I provided value. We've scratched the surface. There's an awful lot to IBC. The best thing for viewers to do is, like once I said, go back to our website, ibcanadagroup.com, and take a look at our videos, our YouTube channel, masterclass, the articles. Reach out to an advisor. Say, listen, I want to learn more about this. We'll spend, the hours having a conversation with you. But George, you actually nailed it. I've been talking specifically for the individual, but this is also held by business owners, right? You can have a real estate corporation and have an IBC policy inside of it. You can have a regular business and have an IBC policy inside of it. And the great thing is that money is no longer passive income and is going to be taxable. It's a place for you to warehouse, and then it's going to add to the CDA account upon death. So there's so many things that we can do with life insurance. Infinite banking is just one of those great cherry on top benefits that we're able to utilize that structure and be 100% safe.
All right. Well, thanks very much, Scott, for that presentation. Certainly, I learned something, and I hope all our viewers will find it as interesting as I did. And
much more exciting than a PowerPoint presentation, right?
Well, more interactive, I can certainly say that. Okay, well, thanks everyone for joining us tonight, and we hope to see you on our next one on December the 29th. See you then.